This may not be the only thing you don't want to hear about the economy today.
We are still slowing. We've never been in the recession camp for the US this year, but we think growth is in the process of slowing from almost 3% on kind of a momentum basis early in the year. We're going to end up closer to 1. So for the year as a whole, 1.5, maybe a smidge more, but it's definitely a slowing economy with the weight of uncertainty around tariff policies really putting a damper on growth.
That's Paul Gruenwald, chief economist at S&P Global Ratings. And one of the other things he's going to say that you may not want to hear is that he thinks inflation is headed to somewhere close to 3.5% in the next year or so. He's our big interview in a show that starts with Todd Rosenbluth, head of research at Verify, who puts the specialized ETF counterpart of one of the greatest mutual funds of all time, a fund that, oh, by the way, is one of my biggest holdings, as today's ETF of the week. Plus, the Federal Reserve held interest rates steady on Wednesday, and while there are signs that a cut could be coming at their next meeting, I'll explain why I still think that's not gonna happen.
Believe it or not.
Well, that's what you got to listen to me talking about to decide if you believe me or not when it comes to that part of it. But we have a great show planned for you today. Welcome to Money Life for July the 31st. I'm your host, Chuck Jaffe. Thank you so much for being here. Yeah, we start things off with Todd Rosenbluth. And yes, I love his pick for ETF of the week, but it's not the same as buying the classic mutual fund that it's based on. And so while he's making a case for active management, this is a really interesting case. And by the way, the manager of this fund has been on the show before. He is actually going to be on again in the very near future, within the next 2 months. So super excited for that as well. A particularly interesting ETF of the week. Todd and I kind of joke around that, we're both Michigan grads, but that doesn't mean we come of one mind, right? We're on the same team when it comes to football and basketball and any college sports. Sometimes we're looking at other things, and he's like, yeah, you dig into the stats and find cool things to bring up and what have you. I'm like, well, this is a fund I know really well. And yes, I do know the ETF version of it, even though, again, not identical. And then Paul Gruenwald here. If you want to hear the better news is that although he thinks the economy is slowing and he thinks inflation is rising, he doesn't think we're getting a recession. And so you just kind of muddle through what amounts to a little bit of discomfort. And muddling through discomfort is a heck of a lot better than getting hammered. I doubt that the market's going to get hammered today. Again, the NASDAQ and the S&P 500 are looking at potentially getting back to new record levels. We'll see. That would be the kind of expectations after the trading day we had on Wednesday. The surprise was certainly not that the Fed kept things steady. That, I think, was what everyone expected, including us and our guests here on Money Life. The possible surprise was that you saw a little bit of dissent. I'm Chuck Jaffe, financial journalist, your host here on this show. This show is independent personal finance talk. It's not just about what I like, or even on a day like today, what I'm telling you. We want you to be able to have the courage of your convictions. So if you hear me giving my opinion, or you hear Paul Gruenwald, who is distinctly much more of an expert than I will ever be, well, we hope you're going to take all of that in to formulate your own viewpoint. Don't give me extra weight because I'm the host, because while I formulate my opinions on what I would consider to be a highly educated basis, I'm studying the people who study the market. They are studying the market and the economy directly. I'm more of an expert at asking questions, I would say, than I am at all the things financial. But you can't do what I do without picking up some expertise. You can't do what you do as a listener to a show like this. If you are an active and engaged listener, it will make you a better, smarter, savvier investor, better, smarter, savvier handler of your personal finances. We really appreciate that. And if we can help you do that, reach out and write, chuck@moneylifeshow.com. But right now, let's get you to that take on things, because, again, interesting show. The ETF of the week, and a particularly fun one for me, kicks things off when we come back in just a moment.
To navigate today's complex market, investors need accessible, quality research. Vetify offers free webcasts from portfolio experts and industry leaders. Earn CE credits and take your portfolio to the next level. Go to etftrends.com/webcasts and learn more.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, this is the ETF of the Week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at Vetify. And if you go to vetify.com, the firm's website, you will find all the tools you need to make yourself a savvier, smarter investor in ETFs. Todd Rosenbluth, great to chat with you again.
It's great to be back, Chuck.
Your ETF of the Week is
The T. Rowe Price Capital Appreciation Equity ETF, TCAF, TCAF.
TCAF, the T. Rowe Price Capital Appreciation Equity ETF. Now, I will point out I am a big fan, although I don't own this ETF. It's based on the T. Rowe Price Capital Appreciation Fund, one of the best mutual funds of all time, and one of the biggest holdings and longest standing holdings, longest tenured holdings in my own portfolio. So I'm really curious why you take this all-time classic that's relatively new in the ETF wrapper and make it ETF of the Week now.
So let's talk about what it is and what it isn't, and then I'm sure we'll dive deeper into it. But TCAF is a roughly 2-year-old ETF that's already gathered over $5 billion. It's the stocks that David Giroux that you mentioned and team are favoring within that broadly diversified multi-asset fund. So this is just stocks. This isn't stocks and bonds. It's mostly the same ideas, the same investment process on the stock selection standpoint, but this is not a ETF share class of the pre-existing mutual fund. It's its own entity. And what it is a strong performing entity. So TCAF has performed relatively well. When I last looked this year, it was outperforming the S&P 500 index. Again, $5+ billion for a new ETF. We've talked about a couple other T. Rowe Price active ETFs. They have a strong heritage within the active world, primarily in the mutual fund world, but they've been having a lot of success in the ETF space, and this is their leading product.
It is T. Rowe Price Capital Appreciation, frankly, also their leading mutual fund if you're just looking at classic funds. So let's talk about a couple of things because, yes, you're going to get a lower expense ratio. The expense ratio on TCAF, about 30, 31 basis points as opposed to 70 basis points for the classic mutual fund. As you pointed out, you're only getting the equity, but that raises an interesting issue because David Giroux, the portfolio manager, was just named Outstanding Portfolio Manager for the allocation category by Morningstar in 2025. Now, it's the third time that he has been a Morningstar Manager of the Year. He won it in 2012 and 2017. But one of the things that they noted is that David, with the mutual fund version of this fund, which is PRWCX, set a record for fund managers because he just last year completed his 17th consecutive year of being above average. So in other words, he has beaten the average fund. He's typically been in the top third of all of his funds. That is what he expects to do. I mean, that's a bare minimum. He's told me in the past he would be very disappointed if he did not do that. Well, a funny thing, because when you go to TCAF, the fund came out in 2023. 2024 was its first full calendar year. Guess what? In its Morningstar category, it finished in the bottom half. It finished in the 60th percentile. Now, it's in the top 20% this year, and it certainly has got the track record. But does that tell you anything about, like, hey, we look at something and we try to make sense of the numbers, but it's a little bit how you cut the pie that determines, this guy's good and this guy's maybe not so good, right?
Well, I think his long-term track record shows he and the team around him are excellent at doing security selection. If you're going to believe in active management, and this is, of course, an actively managed ETF that we're talking about, TCAF, you have to have confidence in the manager and you have to have confidence in the firm. I think that longer-term track record that David Drew has established at T. Rowe Price, and that T. Rowe Price has established within the active space, sets the tone. I don't think you should judge a fund based on necessarily 1 year of performance. I did note that it was outperforming this year as a fact. You're right. I think it in the Morningstar category. If you say it, I believe you. Where it landed, I think if you want a growth at a reasonable price active manager in the ETF wrapper, that TCAF is a great example for it. And to me, this is, I'm going to get the name wrong, or I'm not going to give a good name as the example, but this is a well-known chef who has had a string of higher end restaurants that now is offering like a burger shop, high quality burgers, same standards, same version, same ingredients, or a version of those that's tied to it. It's different. Is it the right thing for you if you're looking for an actively managed US equity focused ETF? Then yes. If you're looking for a multi-asset strategy, that's not what this is.
It's interesting to me because as much as I have talked to David Giroux, in fact, I expect to have him as a guest on Money Life again in the not too distant future. So I may have to ask him this question. I do wonder at times when we take a fund, like you and I have talked plenty of times about, you take an index fund and you make a few changes and suddenly it's not the same index fund. You know, if you look at the classic fund, again, one of my largest holdings, it's only about 55% equity. It's 30+% fixed income. It's almost 10% cash right now, the last time I checked. So here he is being picked as a great allocation manager. Now, he's obviously a great stock picker. He's got decades of experience showing that. At the same time, do you want a manager like this in an adjusted format? Like if you're saying, wait, hold it, I only want part of your picks. Why do you take a great fund manager and not just say, here he is, take him as he is?
Well, this doesn't exist as a multi-asset strategy within the ETF wrapper. It exists in the equity sleeve of it. I looked at the holdings. Obviously, there's not a one for one because the ETF, the holdings are disclosed on a daily basis. So I'm looking right now at July 29th holdings as you and I are talking right now. That obviously is different from a mutual fund standpoint. What I see is stock picking. So there's some well-known stocks, Microsoft and Nvidia and Amazon and Apple are among the larger holdings, but Roper Technologies, PTC is another holding. Centerpoint Energy, my eyes are trying to capture all of them as I look here. So this is not just what you'd find within the S&P 500 from a weighting standpoint. This is the stocks that the team at T. Rowe Price that David leads, shines a spotlight on and favors, and they've done a great job in sorting through that universe. I think if you believe in active management, you want to have a proven manager. He's a proven manager.
No question about that. I do find it interesting. Under no circumstances would you ever say, hey, this is one of those cases where, as you point out, they do not have the one-for-one version of T. Rowe Price Capital Appreciation as an ETF. But you wouldn't look at it from a strategy standpoint and go, yeah, okay, hold the classic fund or what have you. It's always got to be the ETF.
Well, first of all, this is the ETF of the week. So
yeah,
that's why we're talking about
you could not have made that fund the ETF of the week. I get it. But it is still that idea of, do I own the manager in the form that's made him the full reputation or in half of the reputation?
So this is an ETF version of the strategy. Obviously, there's an allocation decisions that are made, but I think that I'm sure that there's a lot of work that goes in to the non-equity part of the portfolio, but they do a very good job of picking stocks. I believe in it. And you highlighted it earlier. 31 basis points is quite low for a core security selection active ETF or active equity ETF. So T. Rowe Price has brought its scale to the table as offering an advantage. Would I pay less money for a version of the strategy? I might. And I think many investors, $5.3 billion of investors agree.
It's a great point. I will also note, as you look at it, as you point out, a core strategy. So let's talk just a little bit about where this fits, because one of the things I could really see with this fund, and I was thinking about it when they first came out with this fund, was that this, for somebody who's like, my core is an index fund, but I want to add some active, this is that I'll be half core with index and I'll be half core with active with one of the best active managers of all time picking stocks. Like that intuitively was what I was thinking this fund would be used for. Is that what you're thinking it should be used for? Or do you like, who should be in this fund?
That use case is a great example of it for someone who wants to pair their large cap exposure with an index and an active based approach. There are many people that believe in active management and they want to work with an established active manager in the ETF format. I think for some advisors, some investors, they've replaced the S&P 500 based index product. They're paying a little bit more to get exposure to security selection. This is an ETF that is well diversified across sectors and stocks. So you're getting what you might from an index, or some of the things you like from an index-based approach, but with an active manager. So, and before you come to me on it, last week we talked about an index fund. Next week we might talk about an index fund. We're going to rotate through these things with the various use cases.
Absolutely. And totally worth doing that because it exposes us to different ideas. This, of course, like we've said, a tremendous mutual fund manager, active track record, better than almost all out there. And this is a way to get the equity picks and add that to your portfolio. It's TCAF, T. Rowe Price Capital Appreciation Equity. It's the ETF of the week from Todd Rosenbluth at Vetify. Todd, really fun. Talk to you again next week.
It's great seeing you, Chuck.
Todd Rosenbluth is the head of research at Vetify. Go to vetify.com to get more information on your favorite ETFs or maybe the ones you're thinking could become your next favorite ETF. Todd, of course, starts us off every Thursday here on Money Life, and we are just getting started. Later, I'll be talking with Paul Gruenwald, chief economist for S&P Global Ratings. But up next, I'm going off the news to give you my reaction to what happened with the Fed in the FOMC meeting yesterday. So are they cutting rates this year? Well, maybe the odds went up, but I'm still saying no, and I'll tell you why next.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome back to Money Life, where we're going to go off the news, and I'm not bringing in a guest to do this. I'll quote a guest or two, or an expert or two, but I'm going to be the one guiding you through this because I've got pretty strong opinions, and I want you to get my take on how I'm reacting to this news. So the Federal Open Markets Committee, the FOMC, the Fed's 12-member policymaking panel, voted on Wednesday to hold the federal funds rate steady. So it's 4.25% to 4.5%. Now look, tariff-fueled inflation, federal job cuts created by DOGE, immigration policy, those things are top of the mind at the Federal Reserve. So is your family's spending and its budget and its household debt. All of those things impact the cost of borrowing money, and also they impact how the Fed's latest decision on monetary policy winds up impacting the U.S. economy. Lower borrowing costs, if the Fed were to cut rates, encourage businesses to invest and expand. That can lead to job creation and wage growth. For consumers, lower rates mean increased disposable income from lower debt payments, which you could translate into higher spending on goods and services, which can drive economic growth. So that's what people are hoping they're going to get out of rate cuts. But like I said, we didn't have rate cuts. We did have some dissent. 2 governors wanted rate cuts, but I will point out that those governors were Fed Vice Chair of Supervision Michelle Bowman and Governor Christopher Waller, both of whom are considered strong candidates to get President Trump's potential approval to be Jerome Powell's replacement. So you can imagine they were feeling some pressure already to make their vote and put pressure on Powell. They did put pressure on Powell because FOMC votes typically are unanimous. The last time a member voted against the unanimous opinion of everybody else was September of last year. The last time there was a double dissent, 2 members going against, that was September the 20th, at a time when rates were between 0 and 0.25%, and 2 governors wanted an increase. Prior to September of 2020, from what I was able to glean in a not completely exhaustive search, The last time there was double dissent, Alan Greenspan was chairman of the Fed. It was more than 30 years ago. So look, there's clear and present danger of slower growth as a possible offshoot to decisions that help stop tariff inflation from being sticky, right? Businesses could absorb costs, and if they do, then tariffs don't have to raise prices. But if businesses absorb the costs of tariffs, that means tariffs slow growth rather than hike inflation. You could argue that that's the trade-off we've largely seen to this point because we haven't seen inflation go dramatically up. You could say, yeah, you've got some businesses, they've been waiting and they've been eating a little more of the cost than they will while they wait for more certainty on tariffs to play out. In fact, that's what you heard from economist John Sylvia from Dynamic Economic Strategy on this show last week when he said clarity on tariff prices would be the ultimate trigger to a spike in inflation. The Fed's wait-and-see approach, it's a cautious stance in a post-pandemic economy that's been marked by persistent inflation, but also by geopolitical uncertainties, including, but not limited to, trade wars. You know, the Fed has two priorities. It's what they call the dual mandate. It is maximum employment and price stability. Those goals require them to balance macroeconomics because higher interest rates lower inflation but increase job losses, and lower interest rates decrease unemployment but increase inflation, right? So you have that delicate balance, and the Fed uses interest rates as a tool to manage its mandate. By the way, that's what also every central bank does. Like, it's not that the Fed is somehow different than foreign central banks. And you hear me frequently talking about foreign central banks. So the Fed sets short-term benchmark interest rates for borrowing money. This is what you're going to pay on your credit card. It's going to impact your home equity and your auto and your student loans. But it's the 10-year Treasury bond yield, which the Fed has nothing to do with. That's the benchmark for longer-term interest rates like 30-year fixed-rate mortgages, which, by the way, are currently hovering a little bit under 7%, right? The Fed wants to see inflation back at its target rate of 2% and would like to avoid cutting rates till we get to that level. The July meeting, the one we just had, did not include the dot plot, as it's called, the summary of economic projections. But the September meeting will have those revised forecasts, an updated dot plot based on what they think inflation, unemployment, and interest rates could be at. And the next FOMC meeting is September 16 and 17. So the FOMC said, and I quote here, that uncertainty about the economic outlook remains elevated. It's not a big statement. Jay Powell explained that while the labor market appears solid, the risk of tariff inflation is still up there. It could be a one-time hit or it could linger longer. Despite that, you had those two Fed governors said they would both want a 25 basis point, 0.25% cut in the federal funds rate. Both said previously that a rate cut would be warranted if inflation numbers appeared to be tamed. And I will point out that while their dissent was a story, it was not a big surprise. I will also point out, I should have asked Greg McBride about the likelihood that we'd see that dissent, and I blew it on that one. I'm sorry, I should have done my job a little bit better. So now the question is the Fed going to cut rates in September? Now, if you've been listening to the show, you know I've said, including something I said in that interview with Greg McBride, that I don't think we're going to see rate cuts this year. I will fess up to the fact that I would raise my potential expectations for a cut, but I'm still on the side of no right now. Because unless the data changes, and we get 2 months of new economic data about prices and jobs, it's the July and August numbers before we get to September, unless the number changes, I think we're going to get close to September. And without a change in numbers, you're going to see the traders and the prognosticators start to say, okay, Fed's going to cut, but it's not going to be September. Now it'll be October. Now, there could be a market impact to the Fed waiting, right? If the Fed waits longer, it makes investors nervous. Stocks are overvalued, need to take a breather. But the Fed's not going to react to market moves, which are inherently fleeting and which have nothing to do with its mandate. I think the numbers support what I'm saying about the Fed. GDP increased only an adjusted 1.25% for the first 6 months of the year compared to last year. CPE, personal consumption expenditures, that's the preferred version of inflation measure that the Fed likes to use, increased 2.1% compared to 3.7% back in the first quarter. Core CPE was up 2.5%. The consumer price index for June, 2.7% year over year, the highest increase since February. The June dot plot, the one we got last month, showed inflation going above 3% this year, but it didn't necessarily show the Fed as being ready to act. Rick Reeder, who is BlackRock's chief investment officer of global fixed income, he's head of BlackRock's global allocation investment team, he said that he reads the FOMC as saying that rate cuts are closer at hand than they were in June. Okay, I kind of said that too, though I'm still thinking September's not going to happen. But since I thought we weren't getting cuts this year, well, October is that compromised position for me. Reeder runs a ton of money, and I don't. He says conditions are, and I'm quoting, now quite ripe for a reduction of policy rates. So again, he's thinking September. But what is more important is that Reeder says, and I'm quoting again, this is a generationally attractive time to build income and yield into portfolios. He said he's very comfortable as investors holding income-producing assets in fixed income today, especially at the front end to the belly, the middle of the yield curve. That is incredibly similar to the message you got on this show from Matt Miskin of Manulife John Hancock last week. I think this is now becoming about how the Fed reads what's next. And I'm not sure the data will be clear. Consumer spending, still positive, decelerated from the previous quarter. Americans are becoming more selective, more cautious. They're saying in the soft data stuff that things are bad, but they're not panicking. They might be hesitating. And growth isn't reversing, it's thinning out. The Fed has always said it's data dependent, data driven. Well, the data is evolving. So what I will say is that while I wouldn't overhaul a portfolio based on things like rates, I might tilt or move a portfolio a little bit looking ahead in an environment where you could be seeing lower inflation, lower growth, and maybe, just maybe, lower rates before the end of the year. Look forward and consider what's next. Maybe locking into good rates now, taking advantage of what BlackRock's chief fixed income guy just said was a generationally good outlook, rather than waiting and reacting to rates later. I'm thinking that if you make moves or adjust your portfolio now, this market could reward forward-thinking strategy over reactive strategy. I got a rate cut. What do I do? So I think, in spite of the fact that I hold to a prediction of no rate cuts this year, with a bit of a softening towards I won't be that surprised if it happens, particularly if it happens in October, that you want to prepare for rate cuts. Because the talk of rate cuts is going to make markets volatile, even if the cuts don't come. So we've been pretty benign of late. I think we will see volatility go, particularly as we get closer and if we wind up seeing more talk about things pushing back. So look at your portfolio and make sure you're not going to be caught unprepared and unaware. I'm not saying that rate cuts will be a big boon for the market. I'm also not saying that a lack of rate cuts would be a big problem. But the numbers suggest that both of those extremes are possible. Like you could wind up seeing a big boon or a big problem. So preparing for a storm while the seas are relatively calm, which, by the way, was what Frank Holmes was advocating on this show yesterday, that seems to be about the right way to go for now. My call may be wrong. I'll be the first one to tell you that. Again, guys like Rick Reeder who are calling for something different, they manage a ton of money, and I don't. But watching what the Fed is doing, which I do along with everybody else, yeah, I think they're holding to this course, and I think you need to adjust to it. We'll find out what Paul Gruenwald from S&P Global Investors thinks in the big interview next.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Welcome to the big interview on the July 31st edition of Money Life. Returning to the show today, Paul Gruenwald. He is chief economist at S&P Global Ratings, spglobal.com. If you're looking for more information, and it is always great to have Paul on the show, so I'm happy any day I get to say, Paul Gruenwald, welcome back to Money Life.
Great to be here, Chuck. Thanks for inviting me back.
This economy, well, frankly, it keeps going. It's kind of the Energizer bunny of economies in spite of everything we think should be going wrong. And in fact, there's a lot of stuff we could look at and go, hey, this is the economic reaction we would expect, but we haven't been getting it. So I want to start with your take on where things are headed next, what your outlook is, but also, is there a reason why this economy has not been behaving the way classically trained economists think it should have been behaving?
Right. Well, let's start with tariffs. That's probably a good place to start. Over the last week, we've got a couple of more deals, or at least preliminary deals or agreements with Japan and with the European Union. Looks like the minimum tariff rate now is going to be around 15%. What these deals hopefully do is take out some of the uncertainty. And Chuck, to be honest, it's not the tariffs per se that are driving the forecast lower. It's all the uncertainty about policy and firms holding back investment, consumers holding back spending. So we are still slowing. We've never been in the recession camp for the US this year, but we think growth is in the process of slowing from almost 3% on kind of a momentum basis early in the year. We're going to end up closer to 1. So for the year as a whole, 1.5, maybe a smidge more, but it's definitely a slowing economy with the weight of uncertainty around tariff policies really putting a damper on growth.
Is there a reason why we haven't seen some of this slowdown till now? I mean, tariff impacts, I guess the question is, are we actually going to see them? Because we know what we've been expecting, and it hasn't been nearly what we've expected.
Right. Well, the way that we think about that is if you look at our current estimate of the effective tariff rate, import tariff in the US is about 17.5%. But if you look at the tariff collection, the implied rate is only about 10. So why is it so low? We know that importers were front running the tariffs. We had this big surge of imports in March before the tariffs took effect. That stuff was put into warehouses. Now it's getting taken out of warehouses. So we think over time that as the inventory clears and everything else clear up, the tariff rate is going to kind of rise toward 17%. That's going to continue to squeeze growth. But again, for us, that's a growth slowdown or a growth recession story and not an outright recession story. The secret sauce, Chuck, you asked that earlier, for us has been the labor market. The labor market's still hanging in there. I would say the strength of the labor market is narrowed, but we're still very close to full employment in the U.S. We've got 4.2% unemployment. Yes, new hires are easing, but fewer people are quitting. But as long as the labor market stays reasonably strong, we're probably in a slowdown world rather than a recession world.
I have talked to some economists who said that while we had the uncertainty, they felt that companies were trying very hard not to raise prices, not to let the tariffs sink in, because they didn't want to be seen as being overreactive or somehow greedy at a point where they did not know. If that is true, then with certainty comes the price increases that we've been waiting for. Do you think inflation is going to have the spike that people have talked about? And is it a one-time spike, or is it something that's going to be lasting?
Okay, let me back up one step. Somebody has to pay the tariff, right? We know when the goods come into the country, the importer pays the tariff. But what we call the incidence, who ultimately pays it? Is that the importer? Is that the wholesaler or the reseller taking a margin hit? Does that get passed on to consumers? Or does the rest of the world kind of lower their prices to offset the tariff? we can rule out that last one. We know from the first Trump administration that only 5% of the tariff got absorbed by the rest of the world in lower prices. So the question is for the US, which is paying 95-ish% of these tariffs, how much do firms absorb and how much do they pass on to final consumers? We know that firms have been absorbing some of that so far because we've seen some weaker margins, but what we expect over time is roughly half of it's going to be passed on to consumers. We're expecting a jump in the consumer price index, which is going to be a jump in the inflation level. We think that's going to get to 3.5-ish by the end of the year, but we don't really call that inflation. That's kind of a rise in the price level. It probably won't be sustained, and it's not going to, start a new inflationary cycle, but it's going to cause the Fed and others to kind of pause and wait to see what happens. But that headline inflation number that we all like to look at, that's going to go well above 3% later this year and into early next year. Again, we think that's going to top out around 3.5. Depends how much of the tariff gets passed through to consumers and how much of it gets eaten by lower margins.
Will that cause the Fed to finally act? Will we get to a spot where the Fed cuts this year, or are you in the camp that the Fed is going to wait for the data and it's perfectly happy to wait till next year and it may need to wait till next year?
Well, we think the Fed is still on hold. We think it's a wait and see mode. But remember, the Fed's doing two things. It's trying to ensure low and stable inflation. And it's trying to make sure we've got a healthy labor market. We think the Fed's going to go twice this year, once in September and once in December, as it becomes clear that the inflation is anchored over the medium term and maybe the labor market's going to soften a bit. Earlier calls this year for the Fed, whatever that was, 4, 5, 6 rate cuts, we were never in that camp. But remember, the Fed is still on the high side of neutral. We think neutral is about 100 basis points lower than it is now. So there's room to cut rates, but again, they're going to see evidence of weakening economy and hopefully a plateau in inflation, and then they're going to gradually lower the Fed funds rate.
Let's talk a little bit about the other end of the tariffs, because obviously we're seeing other countries impacted. And it's not just things like the European Union settling, it's what's going to wind up happening in China. And you were pretty optimistic in your mid-year commentary, which, by the way, we will make sure that we link up for folks in our show notes, et cetera. But in your mid-year commentary, you were pretty optimistic on potential for China. So what is your take on what's going to happen there, both with trade wars, but also with China's growing economy as it fights through this thing?
Yeah, well, let me sort of answer that two ways. One, I was in China about a month ago. There's something called the China Davos, which is the Chinese version of the Swiss Davos. And that's a big gathering. There's 1,700 people there, a bunch of countries. The Chinese premier spoke. I was surprised how optimistic the Chinese officials were and the Chinese business people were. They had just come off the big spike in tariffs with the US. Remember, both sides went to triple digits. China seemed to weather that well. We've got the 6-month pause. The economy seems to be picking up a bit again. They've got world-beating technology on batteries and solar panels and EVs. They're exporting more to the rest of the world and less to the US. So there's a reasonable amount of optimism around China. They've still got a property overhang and some demographic issues, but we upped our forecast back to around 5% this year for China. There's still problems, but they're relatively insulated these days against U.S. tariffs and other places they've got to export their overproduction. It's not all roses for China's economy, but outlook's looking a little bit better than it was even a few months ago.
And while you look at the economics more so than the investable side, how investable is China right now, given the potential for a trade war? Like, there are plenty of people who will tell me they can't go there or they struggle to go there. Would you be going there right now as an investor, or would you be waiting for more certainty and clarity?
Yeah, we're going to do a pretend investor here since I'm not supposed to be giving investment or policy advice. But, China's trying to do a bunch of things. It's trying to make their economy more sustainable and less reliant on energy. They're a big oil importing country. They're trying to rebalance the economy away from inflation toward consumption, and they're trying to rotate trade to the rest of the world. So it's a tricky investment environment for someone who wants to go in there. They're making progress in fits and starts on various fronts, but the sort of the fast growth phase of China is behind us. They're becoming a world leader in some of these industries, but they've got to figure out, what they're going to produce, kind of rein in the overproduction, who they're going to export to, and then they've got this geopolitical battle with the US. So it's a tricky space. Again, I'm not giving investment advice, but there's a lot of moving parts to the Chinese story. And remember, they don't have well-developed, deep, liquid, transparent capital markets the way we do here in the US. So that's just another complicating factor.
Given where this economy has been, it has been all about consumers and consumption staying up while labor markets stayed roughly where they were. Given that the soft data says consumers are unhappy, in spite of the fact that the market's gotten back to record highs, as consumers, they're facing inflation and the rest, how much do you worry that the consumer at some point is going to have a break?
Well, that's been the big secret sauce of the US, as I mentioned earlier. It's consumers spending money. The labor market is strong. As long as people continue to have jobs and think they're going to continue to have jobs, and their, portfolios are doing well, for those who have got, an investment side to think about as well, then we think spending is going to hang in there. Your point about the soft data, the survey data, and the hard data, which is the stuff we actually measure, the physical stuff. There was a gap earlier this year. The sentiment data was actually quite weak, and a lot of folks, including ourselves, were writing about that, right? One of those two had to be wrong. You've got a very weak sentiment and soft data story and a reasonably resilient hard data story. What we've seen over the last few months is actually the soft data become a little bit better. So it looks like the battle between the hard data and the soft data, at least for now, looks like the hard data is winning that. And again, I wouldn't call it a soft landing. We're kind of going into a growth recession, but some of the gloom and doom that was implied by the soft data and some of the recession calls, I think that's at least for now off the table.
When it comes to parts of the economy that are doing well, et cetera, obviously AI is the story everyone wants to talk about. When people are saying AI is the next industrial revolution and can power the economy, et cetera, for decades, do you see it that way? I mean, that's a pretty big mission, yet right now it seems to be carrying that water.
Yeah, well, some people liken it to electricity, right? Electricity was invented by Thomas Edison, as we know, in the late 19th century, and it actually took a couple of decades to work its way through the economy. Maybe the high point was Henry Ford figuring out how to use electricity for, production lines and really boost productivity. There's a huge debate right now, Chuck, around productivity. AI is going to make us more productive, but there's a good way and a bad way. The good way is you produce all these goods and services you hadn't thought of before, powered by AI, and the production frontier moves out, and we get a period of high growth. The other productivity story is just we replace a lot of labor and we produce the same stuff now, but with fewer workers. And that's a good productivity story, but that's not a good growth and employment story. I think in the kind of on impact, there are going to be some job losses. But again, if you think about electricity and all the things that came out of that, like the production line that nobody imagined when it first came out, that's the optimistic case. But this is a multi-year story. We're still in very early days. Even we economists as a profession, the medium-term growth impact estimates for AI are all over the place. They range from kind of zero-ish to adding 1 percentage point of GDP to growth for 5 to 10 years. So we're going to have to see how this plays out. Very early days.
We've seen a huge rally in international markets, but international markets also dealing with the same economic impacts. International central banks, much more likely to cut than the U.S. has been to this point, et cetera. Where are you on international economies? Obviously, you talk about economies and not markets, but I've talked to some stock guys who say they think the international rally is played out, but they're looking at the market, not the economy. So if we're poised for the kind of growth you're talking about with all the good things there, how compelling are international values beyond China?
Right. Well, markets and economies don't always line up, as we know. Again, we've got a slowdown in the US, but then we've got a pickup from next year onwards. That's going to be powered partly by AI, partly going to be powered by some of the supply side reforms that the new Trump administration is putting in place. But again, for the US, and I guess for everybody, this uncertainty overhang around US trade policy kind of narrowly and US policy more generally, that's got to normalize or neutralize or stabilize or whatever in order to get that growth story in the out years. China is going to continue to do reasonably well. India is going to be a bigger force. They're now, I understand, producing more iPhones for the US than China is, and they're the growth darling. And even Europe, people don't talk about Europe, but with rising self sufficiency and the big investment in infrastructure and defense, and the Germans are releasing this famous debt break, we've got a kind of modest medium term boost for Europe as well. So it looks like after we get through this soft patch this year, the big if here, if all the uncertainty around US policy diminishes, we've got some decent growth momentum in the next couple of years, powered again by AI and some of the supply side reforms and the geopolitics in a way.
From an economic standpoint, do you believe we will see a boom caused by the policies that are going to wind up creating more infrastructure demands, the nearshoring, things along those lines? B, deregulation. If you wind up limiting or reducing regulation, particularly on the smaller companies, you're freeing up money to be used in other ways. So do those two things happening on the policy front directly translate to an improved economy? Or is that one of those things that, yeah, it's worth talking about, but you're never going to measure it, or you're not going to see it the way we haven't seen everything we've seen with tariffs, expected with tariffs?
Right. Well, I would say I'm going to give you the easy answer first. Directionally, yes, of course. Right. So if you've got supply side reforms, the ease of doing business is better. You've got this AI, powered economy as a tailwind. It's easy to tell a story that growth is going to pick up. The problem with some of the estimates is that it's very difficult to move the growth needle in the US, right? It's a very, dynamic, complex, sophisticated $30 trillion economy. And you can't just cross out a 2% growth rate and say, hey, we're going to grow by 3 for the next 5 years. So the folks who have been doing this for a long time, they think getting growth up by maybe a quarter, even a half a percentage point over a few years, that would be a big win. So we've penciled in growth a little bit above 2% in the US for the next few years, which is a little bit of a pickup with these supply side reforms. But we should resist the temptation to just pop in some suspiciously high growth number and we're going to grow out of all of our problems. That never seems to happen. So we could get a, short to medium term boost to growth. It would be great to get the US sustainable growth rate up above 2, but some of these big numbers I'm hearing are probably not plausible. Let's remember, Chuck, last year and the year before, 2023 and 2024, the US was pushing 3% growth, which is really above its natural speed limit. The speed limit's closer to 2. So again, on a sustained basis, if we could get a little bit of uplift in the US growth, that would be great. But we got to be careful about putting in the big numbers and assuming that we're in some new era of super high growth. We're not in that camp.
Yes, but if I take that answer and I go back to one of the things you said in there, which was 2% growth for the next couple of years.
Yeah.
And you said your case is clearly not recession now. Well, here we are, second half of the year, which means that in your head, you're starting to formulate all the things that'll go into your outlook for 2026, which you and I will be talking about as we get to the turn of the year. So are you thinking right now that your 2026 outlook will also be basically devoid of any sort of recession call?
Oh, yeah. We see if you look at the quarterly momentum of the US economy, it should bottom around the end of this year. So that's probably where we're going toward the end of the year and early into 2026. But if the Fed starts taking its foot off of the brake and we get a couple of rate cuts, and this is the big if again, if we can get a more certain US policy environment, we've got some tailwinds in the economy and growth should pick up next year. We could probably get back close to the 2% speed limit, and then we'll see if those supply side reforms we just talked about start to kick in.
Well, that would be awesome and amazing if we could wind up seeing all of that. Last question, is there anything in your mind that potentially reigns the game here? Is there something that for you is this is the worst case scenario, and oh, by the way, it's not unrealistic?
Oh, but the one thing we've been telling our clients, stakeholders, internal, external, everybody is the labor market in the US has been surprisingly resilient, not just this year, but remember all the rate hikes that started in 22 and 23. A lot of folks were talking about a recession back then. The US labor market has been amazingly resilient, and it's done so again for the first half of this year. If the labor market starts to crack, and if you see the job numbers start to go south, then we're in recession scenario. Then we get the confidence negative shock on top of that, and then we have the so-called hard landing rather than the soft landing. So the labor market data is the most important thing to watch over the next quarter or two. That's going to ruin the party.
Paul, great stuff. I mentioned that conversation we're going to have when you have your outlook for 2026 done. I'm looking forward to that one. But meanwhile, thank you so much for joining me today.
Thanks, Chuck.
That's Paul Gruenwald. He's chief economist at S&P Global Ratings. Go to spglobal.com if you are looking for more information. And if you're looking for more of Money Life, well, there's not much more to go, but stick with us till the end. We will come back, wrap up this show, put a big bow on it, and then we will end it together right after this message. Hard to believe that we have now come to the end of our shows for July. We, of course, still have one day for this week, and it's going to be another great day to live the money life. Tomorrow, John Cole Scott from Closed End Fund Advisors, CEF Advisors, Scott Ladner, the Chief Investment Officer at Horizon Investments, and David Miller, co-founder of the Catalyst Mutual Funds. So it's going to be another great day to live the money life, I promise you. Meanwhile, I thought this day was great. I will point out, Paul Gruenwald talked to me on Tuesday because I had some dental work done and I was not sure I'd be able to talk all day on Wednesday. As I mentioned at the beginning of the show, it didn't turn out that way, but we tried to get the bulk of the show done in advance. Because of that, we were confident that rates would not be cut. But if you're wondering why I didn't ask him specifically about the lack of rate cuts or the increased dissent or something along those lines, well, it's because we didn't have the actual data at that point. Hey, one thing I wanted to mention before we got to the things that you should celebrate today. If you are a shareholder of T. Rowe Price Capital Appreciation, not the one that was the ETF of the week, but the classic fund, which I told you is in my portfolio, you may have just gotten something from T. Rowe Price about them basically changing or adjusting share classes if you have enough money, not just in that fund, but in a bunch of its funds or most of its funds that basically will lower expenses. And the good news is you don't actually have to do anything to make that happen. Like it should happen automatically according to what I read. But you could kind of opt in and say, okay, I want this. And you do want this. And I would just point out, this is the kind of thing that investors are notoriously bad at. They don't read the documentation and they don't find when something could move or they could make a change that would give them a bit of a savings. And if they're offering you an institutional share class with a lower management fee, you take it 100% of the time, even if it's not available on all of your funds. Like for T. Rowe Price, they're doing it for some accounts where you have enough money. So maybe you've got a couple of different T. Rowe funds like I do, and you're not always above the break points, if you will. So you're not getting a break on everything. Okay, once you know it, you can say, hey, maybe I want to tilt a little more towards this. If I can get it over the break point, maybe I want to consolidate my portfolio. If I'm not impressed with one fund, I can move it into something else, get the two of them now combined into one account, and then move it over the limit, get my expenses down. You want to look at what's going on. So if you're a T. Rowe Price shareholder, I wanted you to be aware, watch your mail, make sure that, if you're qualifying for it, if you do it. And if you didn't get it and you're wondering, go ahead and call the company up and go, I heard something about you guys lowering expenses, but I didn't get anything about it. Is this happening to my holdings? So there you go. Meanwhile, if you're looking for something to celebrate, I normally don't start with food. But I am starting today with spam because it's National Spam Day. Whether you like spam or hate spam,
I don't like spam!
in this case, it's actually about Spam the meat. It is not about spam the bad email stuff.
I don't want any spam.
Yeah, well, maybe you don't want to celebrate spam, but today would be the day you celebrate spam. And again, spam the food, because who would celebrate the other stuff? It's also National Intern Day, National Mutt Day. Well, that's Muttley, who is a mutt. But, Maho is a golden doodle, which technically it's not a purebred, but I also don't know that it's a mutt. Yeah, and it doesn't sound that big, that's for sure. And then everything else we're celebrating today is on the food front because it's Shredded Wheat Day. It's National Avocado Day. It's National Chili Dog Day. I may have to celebrate. I got good dogs and I got chili here. I think it's Chili Dog Day for me today. It's National Raspberry Cake Day. Also National Cotton Candy Day, as if you didn't have enough sugar. And then adding to it, National Jump for Jelly Beans Day. So yeah, the sugar intake is insane. My guests today were Todd Rosenbluth, head of research at Vetify, which is online at vetify.com, and Paul Gruenwald, chief economist for S&P Global Ratings, online at spglobal.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from William Wordsworth, who said, "Let us learn from the past to profit in the present." Well, we're learning as we watch all the stuff happen, like the Fed and everything else that's going on. We are trying to make sure we factor everything in. And while we're doing that, let's also remember that until we do this again the next time, the best thing you could do for your money, so that you're learning from the past to profit in the present, is to not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
It's over. It's finished. It's done. Goodbye.